Okay, so you want to own an AI cloud company. Warehouses full of the most sought-after chips on the planet. A waitlist of customers begging for compute capacity you don't even have yet. And a pitch that writes itself. Rent out the shovels for the biggest gold rush in the history of technology. You picture yourself as the picks and shovels genius, printing money simply by owning the infrastructure everyone else needs to build the future. That's the fantasy. Here's the actual business hiding underneath it. An industry where the core asset, a graphics processing unit, starts losing real economic value the moment it's plugged in. Where you're borrowing hundreds of millions of dollars to buy hardware from a single supplier who also happens to be your most important potential competitor, and where the entire business is a bet that renting out compute at today's sky-high prices will generate enough cash before the hardware becomes technologically obsolete and the rental price collapses under a wave of new supply. Some AI cloud companies have built genuinely extraordinary, fast compounding businesses riding the most explosive demand curve in modern technology. Others have taken on crushing debt to buy chips at the peak of a hype cycle, only to watch utilization and pricing both fall together. The worst possible combination for a business built entirely on debt-financed hardware. By the end of this, you'll understand exactly why owning an AI cloud company is one of the most explosively lucrative, capital-intensive, and quietly terrifying bets in the entire technology economy right now. What you're actually buying before the money makes sense. You need to understand that AI cloud company actually spans a genuinely wide range of businesses with dramatically different risk profiles. And where a given company sits on this spectrum explains almost everything about whether it's a durable business or a leverage bet on a hype cycle continuing. At one end sit the hyperscalers, Amazon, Microsoft, and Google, who have built AI compute rental into an enormous, but still relatively modest, extension of cloud businesses that already generate hundreds of billions of dollars from a diversified base of ordinary enterprise workloads. Meaning AI compute for these companies is a genuinely important growth driver layered on top of an already massive, already profitable, already diversified existing business. At the other end sit the so-called neoclouds, a wave of companies that emerged specifically over the past several years built entirely around one thing: acquiring as many of the most in-demand AI chips as possible and renting out access to them. Companies with no broader diversified cloud business to fall back on. No enterprise storage or database revenue cushioning the ride. Just a balance sheet full of chips and debt, and a bet that demand for that specific compute will remain strong enough, for long enough, to pay off the hardware before it becomes obsolete. In between sit specialized GPU cloud providers and colocation-style AI infrastructure companies that lease data center space and power specifically to house other companies' AI hardware, capturing a smaller, more insulated slice of the value chain by providing the physical real estate and power infrastructure rather than owning the chips and the associated obsolescence risk directly. Understanding which of these models a given company occupies matters enormously, because a hyperscaler's AI cloud business is protected by the kind of diversified revenue base and balance sheet strength that can absorb a temporary downturn in AI-specific demand without threatening the company's survival, while a pure-play neocloud's entire existence depends on one single, currently red-hot, but genuinely uncertain demand curve continuing to justify the enormous debt taken on to build it. The depreciation clock that never stops ticking her is the single most important and most under-discussed structural fact shaping this entire industry's economics, and it explains why this business behaves nothing like a normal real estate or infrastructure play, despite superficially resembling one. A GPU is not a building. A data center facility, once built, can reasonably be expected to remain useful for 20, 30, even 40 years with appropriate maintenance. But the specific chips inside an AI cloud company's server racks face a genuinely brutal, rapidly compressing useful life. Since chip manufacturers release new generations of AI hardware on an aggressive multi-year cycle, and each new generation typically delivers meaningfully better performance per dollar and per watt than the generation before it, meaning a chip that was the absolute state of the art and commanded premium rental pricing 18 months ago faces both technological obsolescence and, critically, declining rental rates as customers increasingly prefer newer, more efficient hardware for the exact same workloads. According to industry financial analysis of cloud infrastructure depreciation practices, this creates a genuinely difficult accounting and cash flow reality. A company that finances GPU purchases with debt carrying a 5 to 7 year repayment schedule is making a bet that those chips will generate strong premium rental income for the full duration of that loan. But the chip's actual competitive relevance, as premium hardware commanding premium pricing, may realistically only last 2 to 3 years before newer hardware arrives and compresses achievable rental rates on the older generation substantially. A mismatch between the financing timeline and the asset's actual economically useful life that sits at the very center of this industry's genuine structural risk. This dynamic explains why depreciation schedules used across this industry have become a genuine point of financial scrutiny and debate among analysts covering the sector. Since a company that depreciates its GPU fleet over a longer schedule reports higher near-term profitability, but risks understating how quickly that hardware's actual earning power is likely to decline, while a company using a more conservative, shorter depreciation schedule reports lower near-term profits, but arguably reflects the underlying economic reality of this hardware's genuinely compressed competitive lifespan. More honestly, the cost of actually building the capital cost of entering this business at any meaningful scale is genuinely staggering. And the specific mix of costs reveals just how concentrated the supply chain behind this entire industry actually is. According to industry cost estimates and public disclosures from companies operating in this space, a single top-tier AI training chip commonly costs $25,000 to $40,000 or more, depending on the specific model and generation. And a serious AI cloud deployment requires these chips by the tens of thousands, meaning the hardware bill alone for a genuinely competitive scale deployment can run into the billions of dollars before a single dollar of data center construction, networking, or power infrastructure is even considered. This hardware spend is overwhelmingly concentrated with a single dominant chip supplier, whose graphics processing units have become the industry standard specifically for AI training and inference workloads, creating a genuine supply chain concentration risk that runs through this entire industry. Every AI cloud company, regardless of size, is fundamentally dependent on securing sufficient allocation from a single manufacturer whose own production capacity has, at various points over the past several years, been unable to keep pace with the industry's total demand, meaning access to chip allocation itself, not just the money to pay for it, has become a genuine competitive advantage that favors companies with either massive purchasing scale or particularly strategic relationships with that supplier. Data center construction and power infrastructure represents the other dominant cost category, and as discussed in our earlier data center analysis, AI-specific facilities require considerably more sophisticated and expensive cooling infrastructure than traditional data centers, given the extraordinary heat density these chips generate when operating at full capacity, along with the same genuine electrical grid capacity constraints discussed previously, meaning a company building out AI cloud infrastructure faces the compounding challenge of simultaneously securing scarce chip allocation, scarce data center construction capacity, and scarce electrical grid interconnection capacity, three separate bottlenecks that all have to align successfully for a facility to actually come online and start generating revenue on the timeline. A company's financial projections assumed. How the money actually comes back. Revenue models across this industry vary by exactly where a company sits on the spectrum discussed earlier, but the core mechanic for the specialized GPU cloud and neocloud segment is renting compute capacity by the hour or through longer-term reserved capacity contracts. And according to industry pricing data tracked by cloud infrastructure analysts, Rental rates for the most in-demand AI training chips have commanded genuinely extraordinary prices during periods of tight supply, sometimes several dollars per chip per hour for the most sought-after hardware, rates that can generate a company's entire hardware acquisition cost back in well under 2 years, if utilization remains consistently high throughout that period. Long-term contracts with major AI labs and technology companies have become an increasingly central and strategically important revenue structure for the largest neocloud players, specifically because these multi-year reserved capacity commitments provide the kind of predictable, bankable revenue stream that makes securing the enormous debt financing this industry requires considerably easier, transforming what would otherwise be a purely speculative bet on spot market rental pricing into something closer to the asset-backed lending structure more commonly seen in real estate or aircraft leasing, where a long-term lease with the creditworthy tenant allows a lender to underwrite debt against the predictable cash flow that lease represents, rather than against the volatile spot market alone. According to public financial disclosures from companies operating in this space, utilization rate, the percentage of total available chip capacity that's actually generating rental revenue at any given time, represents one of the single most important operating metrics in this business. Since the enormous fixed cost of the hardware and infrastructure investment means a facility running at anything meaningfully below full utilization can quickly shift from generating strong returns to struggling to service its debt, a dynamic that makes securing genuine contracted demand before or immediately after a facility comes online considerably more valuable to a company's actual financial stability than simply having built impressive infrastructure capacity in the first place. The volatility nobody wants to talk about buy-in. The depreciation risk already discussed. This industry carries several distinctive, acute risks. Demand cyclicality risk represents a genuinely significant ongoing concern specific to this moment in the industry's development. Since the extraordinary current demand for AI training and inference compute is driven substantially by a wave of capital expenditure from AI labs and technology companies racing to build and deploy increasingly large models, and several industry analysts and even some prominent technology executives have raised genuine questions about whether the current pace of AI infrastructure spending represents sustainable, durable long-term demand, or a temporary capital expenditure surge that could meaningfully moderate once the current generation of AI model development matures. A question with enormous consequences for any AI cloud company whose entire business model depends on today's extraordinary rental rates persisting long enough to pay off debt-financed hardware purchases. Chip supplier concentration risk, discussed earlier as a construction bottleneck, also represents an ongoing structural vulnerability to the entire industry's pricing power, since the dominant chip manufacturers own strategic decisions about production allocation, about pricing, and increasingly, about whether to compete more directly in the cloud rental business itself, rather than simply selling chips to companies that then compete with each other, can meaningfully reshape the competitive economics facing every AI cloud company simultaneously. A supplier relationship risk considerably more concentrated and consequential than the supply chain risk facing almost any other technology infrastructure business. Financing and interest rate risk has become an increasingly significant concern given how much of this industry's rapid build-out has been financed through debt specifically structured against future chip rental cash flow. Since a genuine demand slowdown occurring simultaneously with the kind of technological obsolescence and pricing compression discussed earlier could leave heavily leveraged companies unable to service debt obligations sized against a rental revenue assumption that no longer holds precisely the kind of compound, mutually reinforcing risk factor combination that has driven distress in other heavily leveraged, rapidly built infrastructure industries throughout this series. And customer concentration risk affects even the largest neocloud players considerably more than most infrastructure businesses. since a meaningful share of total industry demand currently flows from a relatively small number of extremely well-capitalized AI labs and technology companies, meaning a strategic shift by even one or two of these major customers, whether toward building their own proprietary infrastructure rather than renting or toward a competing cloud provider, can meaningfully affect an individual company's utilization and revenue in a way that a more genuinely diversified customer base would better insulate against. The real case study, CoreWeave's debt-fueled Resetto, understand how explicitly this industry's growth has been built on financial engineering as much as on genuine operational execution. Look at CoreWeave, a company that began as a cryptocurrency mining operation before pivoting entirely into AI cloud infrastructure and rapidly becoming one of the most prominent and well-capitalized neocloud players in the industry. CoreWeave's growth strategy has depended substantially on a genuinely innovative and genuinely risky financing structure rather than relying primarily on traditional corporate debt. The company has financed a significant share of its chip purchases through asset-backed lending arrangements, specifically collateralized by the GPUs themselves, along with the long-term rental contracts signed with major customers, a structure that allowed the company to raise enormous sums of debt capital. According to public financial reporting on the company's capital structure, running into the billions of dollars, specifically because lenders were underwriting the loans against the predictable cash flow of those contracted rental agreements, rather than against the company's broader corporate creditworthiness alone. This financing approach allowed CoreWeave to scale its chip fleet and data center footprint at a pace that would have been considerably harder to achieve through conventional equity or corporate debt financing alone. And the company's rapid growth trajectory, culminating in a high-profile public market listing, has been widely covered as a genuine proof of concept for the neocloud business model at scale, demonstrating that a company starting from essentially nothing could build a multi-billion-dollar infrastructure business within just a few years by aggressively leveraging asset-backed financing against genuine, contracted AI compute demand. But this same financing structure has drawn considerable scrutiny and skepticism from financial analysts, specifically because of the depreciation and demand cyclicality risks discussed throughout this analysis. According to reporting and analysis from financial media covering the company, questions about customer concentration, given how much of the company's contracted revenue reportedly flows from a relatively small number of major AI lab customers, and about whether the company's asset-backed debt is appropriately priced given the genuine uncertainty around GPU depreciation and long-term demand durability, have made CoreWeave something of a genuine bellwether and stress test for the entire neocloud financing model, with the company's ongoing performance widely watched throughout the industry as a real-time indicator of whether this specific debt-heavy, chip-concentrated business model proves durable across a full economic and technology cycle, or whether it represents a company that scaled brilliantly during an extraordinary demand spike, using financing structures that prove considerably less resilient once that spike inevitably moderates. CoreWeave's story illustrates a genuinely important structural lesson specific to this industry. The same asset-backed financing innovation that allowed unprecedented rapid scaling during a historic demand surge is precisely the mechanism that concentrates genuine risk. If that demand surge moderates faster than the underlying hardware's economic life, or if the specific customers whose contracts collateralize that debt reduce their commitments, a dynamic considerably more acute than the debt risk facing almost any other infrastructure business in this series, given how directly and explicitly the financing itself is tied to both a rapidly depreciating physical asset and a concentrated customer base. 2. Scenarios. Let's build the honest math, the way an actual owner has to run it. In the good scenario, you own an AI cloud company with a genuinely diversified customer base across multiple major AI labs and enterprise customers, long-term contracted revenue that comfortably covers your debt service obligations even under a conservative utilization assumption, and a disciplined chip acquisition and deployment strategy that keeps your hardware fleet current enough to command Strong rental rates without overextending your balance sheet purely to chase the absolute newest chip generation. The moment it becomes available, your depreciation schedule reflects a genuinely honest assessment of your hardware's likely competitive lifespan, rather than an optimistic accounting choice designed to flatter near-term reported profitability. And your utilization rates remain consistently high because your revenue is substantially locked in through multi-year contracts rather than depending entirely on volatile spot market pricing. Under this combination, and during a period where AI compute demand remains genuinely strong, a well-run AI cloud company can generate extraordinary returns on invested capital, since the fundamental unit economics of renting scarce, high-demand compute at premium pricing against debt-financed hardware can be extraordinarily favorable. Specifically, during the window before newer hardware and expanded supply compress those premium rental rates. Now, the harder scenario. You own an AI cloud company that scaled aggressively during the current demand surge, financing a substantial chip fleet through asset-backed debt structured against rental contracts with a relatively concentrated set of major customers, betting that current extraordinary demand and pricing would persist comfortably beyond your hardware's genuinely useful competitive life. AI infrastructure spending growth moderates as the current generation of major AI labs capital expenditure cycles matures, or a genuine breakthrough in more compute-efficient AI training and inference techniques meaningfully reduces the total compute demand per unit of AI capability delivered, simultaneously compressing both the utilization and the rental pricing. Your revenue depends on your chip fleet, still carrying substantial remaining debt obligations sized against optimistic multi-year utilization and pricing assumptions, faces accelerating technological obsolescence as newer, more efficient hardware generations arrive, and your largest customers, facing their own moderating capital expenditure plans, decline to renew or reduce the scale of the long-term contracts that had collateralized your original debt financing, creating a genuinely severe mismatch between debt obligations sized for one demand environment and a revenue reality that has shifted meaningfully beneath you. The gap between these two scenarios isn't a modest variance in a financial model. It's the difference between one of the most extraordinary return on capital businesses currently available anywhere in technology and a company facing genuine, potentially existential financial distress driven by the exact combination of rapid hardware depreciation, concentrated customer dependency, and aggressive debt financing that has made this industry's current boom simultaneously so lucrative and so structurally fragile. The real payoff, the difference between AI cloud companies that build lasting, durable value through this current historic demand cycle and those that end up as cautionary tales of leverage overextension, comes down to a small number of disciplined choices. Securing genuine, diversified, long-term contracted revenue before committing to aggressive debt-financed hardware expansion, rather than betting primarily on spot market pricing continuing at today's extraordinary levels, has proven to be the single clearest differentiator this early in the industry's development between companies building something durable and companies simply riding a demand spike that history suggests eventually moderates in every technology infrastructure cycle that has come before it. Maintaining honest, conservative depreciation assumptions that reflect the genuine, rapidly compressing competitive lifespan of AI chip hardware, rather than optimistic accounting choices that flatter near-term reported profitability while quietly understating how quickly that hardware's earning power is likely to decline, matters enormously in an industry where the gap between accounting profitability and genuine economic reality can widen dramatically. And suddenly, the moment a new chip generation arrives and compresses achievable rental rates on existing fleets, and building genuine customer diversification, rather than concentrating debt collateralizing contracts among a small number of major AI labs whose own capital expenditure plans could shift considerably faster than the multi-year debt obligations financed against them, provides real insulation against the kind of customer concentration risk that has made companies like CoreWeave a genuine, closely watched test case for whether this entire financing model proves durable across a full cycle. The romance of owning the picks and shovels behind the most explosive technology demand curve in modern history is genuinely real, and the extraordinary returns currently available to well-positioned AI cloud companies are genuinely real as well. But this industry's history is being written in real time, with genuinely enormous sums of debt-financed capital betting that today's extraordinary demand and pricing will persist comfortably beyond the hardware's actual competitive lifespan. A bet that has paid off spectacularly for the companies who got the timing and the financing structure right so far, and one that carries genuinely severe consequences for any company whose specific combination of leverage, customer concentration, and hardware timing doesn't survive the moment this cycle's demand curve inevitably, eventually, moderates. Which means the honest answer to whether owning an AI cloud company can build genuine, lasting wealth is, yes, spectacularly so, for the companies disciplined enough to secure genuine contracted demand, maintain honest depreciation assumptions, and avoid the kind of concentrated, aggressive leverage that has made this industry's current boom simultaneously the most exciting and the most structurally fragile infrastructure story in technology today. But the honest, uncomfortable truth, this entire industry is still in the process of discovering is that nobody yet knows with real certainty which of today's rapidly scaling companies are building the next durable infrastructure giant, and which are simply the most prominent example of what happens when extraordinary demand, extraordinary leverage, and a rapidly depreciating physical asset all compound together at exactly the wrong moment in the cycle. And subscribe to my channel. Thank you.